The other way, actually. It's
This way?
yeah, but on the other head, the other side of your head.
Okay.
Yeah, it'll fit. It'll feel pretty comfortable.
Yeah. Okay.
Is it good? And
That's fine.
we are recording, so.
Okay. Sounds good.
So when you turn your slides on,
Where did my slides go?
and we're recording here. So, okay, great. Slides are on.
Okay.
You want to go
So
back?
let's go back, yeah.
Cool. I'm ready when you are.
Okay.
Okay.
Welcome. Hi, I'm David Croson, and tonight I'm going to talk to you about thinking like your investor. The idea is you're an entrepreneur, you need to raise money for your business in some way, you have a clear idea of what it is that your money is going to be spent for, you're going to have a meeting with your investor and you're preparing for it. And so you're trying to think about what you need to be ready to answer and how you can put yourself in the thought processes of your investor in the situation. So today I'm going to be talking about 4 key pieces. One is I'm going to be talking about how your investor actually thinks about making an investment decision. If you're knowledgeable in psychology, you might remember this as the theory of mind. The whole idea is you're able to take your own consciousness and model how other people are doing things, right? Thinking like them is a very important way to actually embed yourself in their social network and understand how they work. You do this all the time when you're playing games. You try to think about what kind of move your opponent is going to make, what kinds of things they're doing, whether you're playing chess or poker, and how to actually work with them. You want to think about how to actually prepare yourself for this presentation, which is a pretty stressful and high-stakes kind of venture. You want to think about how you're going to negotiate with your investor, what you can go and put on the table, which can be either win-win, which expands the potential pie, or potentially distributive, win-lose, where you have to push back on them. And I want to close with just a few words about what to do when you actually really, really need the money. This is not something that you can do your first time with an investor. You can't very well go up to people you've never worked with before and say, my business desperately needs $50,000, will you work with me? It doesn't work out so well that way. When you've established a relationship with an investor and you say, I need $50,000 more than I originally thought, this is how you go and you generate some kind of creative deal so that you can get the capital that you need. Okay? So let's go on to the next slide. That's basically what I just said. The trick here is that you want to be able to communicate information to your investor so that they can do their job, generating terms for you that you can live with. This relationship is commonly thought of as being adversarial, but it really isn't. You and your investor are both on the same side. You both want your businesses to succeed. Your investor wants you to get the capital that you need when you need it, and they want to participate in your success and help you get there. And so this is a very cooperative kind of relationship. However, people look at the investor across the table and they say, I need to squeeze every drop of juice that I can out of this investor, and investors look at entrepreneurs and they say, how do I bend this entrepreneur to my will? I'd rather make this more of a dialogue and a cooperative relationship that you're going to be continuing for a number of years. Okay? So let's go on to the next slide. I just want to kind of introduce you to a very simple kind of numerical example of how your investor is thinking. Your investor has a portfolio of capital. They're investing in all sorts of things, including your venture, but you're not the only thing that they're investing in. So, angel investors may start off investing $25,000 at a time in a fund. They may put individual investments of $10,000 to $100,000 in an individual company, but it's rare that they're working with just one startup at a time. They're thinking of you as part, right, one brick in the wall of their portfolio rather than the whole thing. But for you, it really is the whole thing. You're all in on your one venture, you're only running one thing at a time, particularly if you're going out in order to get money. And so, again, you see why it's important to think like them in understanding how you can go and sell yourself. And so, think about an investor, nope, we can't go quite yet. Thinking about an investor who's going to be putting in a given amount of money. I'm just picking $1 million as a nice round number which divides nicely. This could be a single investor investing $100,000 in 10 items. It could be a fund which is making 10 investments at the seed stage, right, and then it makes some follow-on investments going on. But the statistics that everybody uses in the venture capital industry is basically 7, 2, and 1. Out of these 10 ventures, you have 7 companies that are basically going to fail, and they're going to very creatively absorb all of your money. You're going to lose $100,000 100% of the time, basically, on those lemon ventures. They happen. There are a lot more ventures out there which are not going to succeed than which are going to succeed, but of course the ones that do succeed pay off so well that they're going to be able to compensate the investor for all of those losses. There are going to be 2 which are not lemons and neither are they cherries. They're basically going to go sideways. You're going to put in the investor puts in $100,000. You as the entrepreneur put in $100,000 worth of effort over the course of a couple of years, and then at the end it's worth $100,000. Those are not actually winning propositions. You said, rats, I wasted my time. Okay, so from an investor's point of view, those go sideways. They're not good because they tie up capital that could be used in order to go and make a return. So there's some time value lost for those kinds of ventures. But you don't really worry about the risk part of those. The capital is safe. And then finally you have the winner, which I'm going to call a cherry to contrast it with the lemon. And the whole idea is that the winner, there's only one of them in any given portfolio, but one winner is really all you need. This winner is going to go and return some large multiple of the original investment. So here I'm going to say you're going to make 9 times as much profit as you originally put in, so it's going to return a total of $1 million, the original $100,000 plus 9x return on that. Okay? So let's think about what happens. You have a group of 10, 7 of which are lemons. Those lemons soak up $100,000 a piece, but they return 0. That's the definition of a lemon. That makes the math easy. And we say, the ones that go sideways, you're going to get $100,000 back. I say you being the investor, because we're thinking like the investor. And for the cherry, $1 million is going to get returned. So how much is coming back? It's 1 million plus 2 times 100,000 is $1.2 million. And the investor says, I've turned $1 million into $1.2 million for this complicated lemons and cherries mixture for an overall return of 20%. So that's just a basic overview of how the math works. Now, that's what happens if you have 7 lemons and 2 normals, right? 2 sideways ventures and 1 cherry. You might be tempted to say, well, what happens if there's more than 1 cherry? But I don't want you to think that way. As we'll see, investors are a lot more concerned about reducing or eliminating lemons or converting lemons into businesses that go sideways than they are about trying to cram more cherries into their portfolio. The whole idea is that a given portfolio is going to have 1 winner. If you have another winner, we're going to go and put it into another portfolio is the idea. We're going to think about how many of these other types of ventures surround these 1 winners. You could double this and invest $2 million and have 14 lemons and 4 sideways and 2 cherries if you wanted to, right? There's nothing magic about the exact number of dollars which are going to the portfolio. But I want to think about it as saying, for every cherry, how many lemons and how many sideways can we actually put up with? Okay, so I want to think about the cherry as the unit analysis. So think about what happens if you're able to, instead of funding 10 ventures, fund only 9. Okay? So if you can eliminate 1 lemon, what happens? Now instead of investing $1 million, that is 10 $100,000 chunks, you're now investing $900,000. You're investing 9 $100,000 chunks because you successfully took several meetings with the entrepreneurs who were going to bring you this lemon. And after talking to them for a while, you said, this is not going to work. And you correctly decided not to give them $100,000. This is your finest hour as an investor because you have successfully saved $100,000 by going to lunch. Right? It's a tremendous, tremendous payoff of not investing in a business which was going to lose your money. And so in addition to the fact that you avoid this loss, you also improve your return pretty substantially. That lemon was not going to return any money for you anyway. You still get the $1 million from the cherry. You still get the $200,000 back from the ones that go sideways. So your total amount returned is still $1.2 million. But now your original investment's not $1 million. It's only $900,000. And so instead of making 20% on your money, you're making 33.33% on your money. So you've improved your expected return by eliminating one of these losers. That's pretty substantial. I mean, proportionally, you've increased your profitability by 62.5%, right? That's a big improvement just by targeting 1 lemon and say, hey, I'm just not going to fund this. Now, you might do another calculation saying, what happens if we can take a lemon and turn it into something which is going sideways, right? You're still going to then invest $1 million, but instead of losing 7 times, you're only going to lose 6 times. You're going to make an extra $100,000, and your return's going to be 30%. So what happens if you can eliminate 2 lemons? If you can get rid of 2 lemons, it's even better than that. Because now, all of a sudden, you're only investing $800,000. You're still going to get $1.2 million back, but you're only going to lose $500,000 before, and so your return's going to be 50%. It turns out the math works out very nicely. If you can convert 3 lemons into going sideways, now you have, you still have some lemons here. You've got 4 lemons, you have 5 that are going sideways now, you have 1 cherry. That 3 lemons going sideways will also return that same 50%. So if you think about being an investor, you're constantly thinking about how to identify these lemons and either not investing in the first place, which is certainly better when you think about it. Your money is not tied up, right? So you're reducing the denominator of the amount of investment that you're making, so your ROI is going to go up. And second is, it's almost no work to not invest in a company. You talk to them a couple of times, you say, sorry, don't call me ever again, you're done with them. It's not like they get to hang around and keep pitching coaching you over and over again, you have to devote several hours a week to telling them no, they go away and you get a chance to talk to another investor. Converting a bad business into an okay business, however, does take up a lot of time. It is a lot of work. And at the end, all you earned was $100,000. You successfully avoided losing 100K because you converted this lemon into a normal, but you're not actually going to make a profit out of this. Before, you saved $100,000 just by going to lunch a couple of times. This is work. It's going to take you years in order to save that $100,000. And so it's far easier just to not fund them in the first place. Certainly a smart investor is going to be interested in not only not funding lemons, but also converting the ones into normal investments. But it's a heck of a lot of work to do a lot of conversions. And so lots of investors say, I don't even want to do that at all. I'd rather just kind of take my chances and not fund a lot of lemons. And they're really, really tough and selective about what's going on. Of course, if they're too selective, they may find that they've eliminated some of their cherries too, and they're kind of back to ground zero. Okay? So let's go on to the next slide. So we're going to be thinking about this in terms of a fund. Now, as I said, when you invest $1 million and you come up with a return of plus $200,000, that gives you a 20% return. That looks like it's a lot. You came out $100,000 ahead, but that's really not that much when you're thinking about being an investor. These investors are looking for returns of 25+% per year. A standard kind of portfolio goal for a fund is to try to turn $1 into $5 over 10 years. You'll often see a lot of funds that have aimed their portfolio at this. If you take a course in venture capital, this is often a common fund structure where they say, we try to invest in different tranches to be able to cash out at plus 400%. That turns out to be a compounded annual growth rate of between 25 and 26%. It's 25.8 something percent. So it gives you an idea of what they're aiming for. 25 or 26% on every dollar in their portfolio every year to compensate them for the risk that they're taking, but they might find lots of lemons and not have any cherries in there at all. Right? So this is a high risk, high return kind of venture. And so if your goal is to turn $1 into $5 over 10 years, let's kind of forget about the normal ones and just think about lemons and cherries and think about how accurate you have to be in making your choices. So if your cherries return $10 for every dollar that you put in, which was the example that we did before, how does this math work? If you fund one cherry and one lemon, right, that's $200,000, right? They're $100,000 a piece. And you have one cherry. Each cherry is going to give you 10 times your original investment. That's 10 times 100K is $1 million. And so it's going to turn $200,000 into $1 million. That achieves your goal, right? 5x return, plus 400% over 10 years. However, that's hard to do. You have to be able to pick winners 50% of the time. That's hard enough to do in the NFL. It's especially hard to do when you're talking about trying to pick ventures. And there are a lot more lemons out there than there are cherries. You think about all the ventures that are out there, how many of them return 10 times their money? Not nearly half of them, right? You have to be super selective when that happens. And so even though this cherry returns 10 times your investment, if you're a professional investor and your goal is to return 5x on your money, you need to pick winners about 50% of the time if your cherries return only 10x. This is why in venture investing, most investors will only consider things which give them the potential for a really, really large multiple going forward. 10x just isn't enough. And it's not that they can't come out ahead. They can't come out enough ahead to justify taking the risk over a long period of time. Certainly if they're professional fund managers, their limited partners are going to be upset with them because they're not going to produce the kind of returns that they promised. And so this is a very difficult hurdle to come about. So now the question is, how much more attractive does it have to be? If cherries return 20 times the original investment, something interesting happens. You can now achieve your goal by picking one cherry and 3 lemons. So you'll notice that that one cherry is going to return $2 million all by itself. And so you want to make 5x, and so you have 400K to work with, and so you already spent 100K on the cherry, and so you have room for 3 lemons to be able to make 3 mistakes and turn $400,000 to $2 million. Notice how when the return gets bigger, you also have to invest more in your fund, right? You're investing in 4 things here rather than 2, and you're investing $400,000 rather than $200,000. You need more money in order to chase after higher return items and still make that same return. Isn't that kind of interesting? It's not too surprising that you have funds that are too small to chase after the kind of returns that they're after, to be able to diversify their portfolio enough in order to be able to take advantage of the fact that indeed there are cherries out there, but they have to weather the lemons in order to do this. So here you only have to pick 25% winners, but notice the number of firms that get funded has doubled as well. Right? Previously 2 firms got funding, now 4 firms are getting funded. The number of bad firms, the number of lemons that are getting funded has tripled. That's more than doubling, and we're going to see it more than double again and again. So if cherries return 40 times, that is your $100,000 returns $4 million, you can afford to fund 7 lemons, and you only have to be 12.5% accurate. And if we move this up and cherries return something like 99 or 100x, right? You could return something. You could invest something close to, I don't know, right? 20 lemons, right? Something like that. Okay? So notice the pattern. The returns from 10 to 40 have gone up by a factor of 4, and the total number of companies that have gotten funded have gone up by a factor of 4. But the number of companies which are not doing well have gone up by a factor of more than that. They've gone up by a factor of 7. You have these investors who are willing to be more aggressive, and they're willing to take more chances at funding lemons when the return on the cherries are higher. And so this is basically the story of high-tech venture capital. You have investors who are willing to throw a little bit of money at just about anything because the potential return for the ones that work out is so high. And it's possible to end up funding 7 lemons and 1 cherry and still actually make your goal. It's a lot easier to be able to pick winners 1 time out of 8 than it is to pick winners 1 time out of 2. On the other hand, if the upside from the investment is less than 10%, you have to get it right almost all the time in order to achieve your goal. This is much more like private equity investing than it is like venture investing. When you're buying a railroad or you're buying an oil company, you're buying an existing staffing company which is pouring out cash and you're just trying to figure out how to make it more profitable, you say, yeah, 70 or 80% of the time this is going to end up returning the kind of money that I have, that I need. You don't have to have it return 10 times that amount in order to actually make your goal on your fund. And so there's this hazy separation between private equity and venture capital, but really the difference is private equity firms don't invest small amounts of money in things that could return 40x. They invest large amounts of money which could return 3 or 4x right over a long period of time. Okay? So what does this have to do for you as an entrepreneur as getting funded? In addition to the idea that the investor is trying not to fund lemons, and that if they do fund a lemon, they're going to go and try to convert it. And believe me, a lot of VCs spend a lot of time with these 7 struggling lemons trying to turn them into something which is going to become a cherry or at least break even. Lesson number 3 is don't be a lemon. I had this as lesson number 1, and I went and put in 2 lessons before that. But I would say renumber that lesson number 3 and say your lesson as an entrepreneur is do not be a lemon. There are a lot of businesses out there which when I talk to entrepreneurs about them, I say, gee, this sounds really interesting. Would you invest $100,000 yourself into this business? And they say, no way, that would be crazy. That's a pretty good indication that you have a lemon. Or that it's something that's very, very unlikely to actually succeed and to produce 10 or 20 times the original amount. And so, if you have a bad business idea, if you have one that you would not actually put money into, don't bother bringing it to your investors at all. They're just going to completely wipe you out and say, I'm not interested in talking to you, I don't want to fund you, you're not even worth taking a chance on to try to work with to see whether we can get our money back. They're willing to take the risk that you're not going to actually return any money because you don't have your ducks in a row. A lot of people look at the venture funding process, and here I'm talking about really angels and angel groups, somebody who's going to put in between $25,000 and a couple $100,000, not multiple millions yet. They think that this is totally a crapshoot. It's entirely random, and that if you bring these VCs 100 venture plans, some of them are going to get funded and you're going to be able to get money and you're off to the races. It doesn't work like that. It is not random at all. These VCs are trying to filter out these lemons. Lesson number 4 is try not to obviously look like a lemon. If you have something which has some kind of potential to it and it has some promise, you want to be in a market where the upside from successful ventures is really high, and now all of a sudden they're willing to fund 7 lemons for every cherry that they get, and they say it's a lot easier to persuade these investors to fund you if they look at you and say, yeah, well, I think this has a 1 in 8 chance of paying off, right? You say, it's not so obvious that this is going to be a bad investment, even though 7 out of 8 of them are going to lose. In the previous example, 7 out of 10 of them were going to lose, and the VC VC still would be able to make a positive return. Here, their goal is to make 5x return over 10 years. If you are a lemon, you're going to have to go and hide pretty well, and the place to hide is in places where there are huge upsides for successful ventures. It's really hard to hide lemons in the private equity world where nearly every deal has to work. This is also a reason why you don't see a whole lot of debt financing for these kinds of high-risk ventures. People who are going to loan you money, as opposed to people who are going to go and buy stock or invest in options or warrants in these things, are trying to get their money back almost all the time. They say lemons are really terrible. I mean, think about mortgage defaults as being like lemons. They want things that pay back in a nice, predictable, normal way. They have to choose nearly 100% of the time just to break even. And so going to VCs with something that is not, which is going to steadily produce a return but has a very, very low chance of actually hitting the ball out of the park, is not going to be able to achieve their objective. Even if you can demonstrate you can make 15 or 20% per year all the time, they'll never fund you because they need to make 25 or 26% on average to hit their goal. Whereas a private equity company would say, hey, you can make 22%, let's talk, right? We can go and borrow money at a lot less than that. We can go and lever your company up. Your cash flow is going to be valuable. We'll be able to make a deal. Right? So lesson number 5, given that you're not a lemon, I'm not interested in showing you how to actually pitch VCs given that your idea is terrible. I'm assuming that you have a good idea and that you're trying to cut through the noise and get them to pay attention to you. If you're not a lemon, be prepared to prove it. The whole idea is you need to go and separate yourself out from the large numbers of people who are sending in bad business plans, who are talking about investing somebody else's money in a bad idea. You need to go and show them beyond a shadow of a doubt that you are not the lemon type, that you're at least a good risk. You may not be able to prove to them you're going to be successful, but you say, I'm above the line. You're not going to fail 7 times out of 8, right? And therefore, you should actually put money. Okay, so let's go on to the next slide. Okay. So, this leads me to something that I've come to realize is a key misconception. Everybody thinks that investors, and I'm talking about, I'm calling them VCs here, but really this is talking about angel investing, right, at the smaller levels, right, as I said, $25,000 to $300,000 or so. Everybody thinks that these investors are obsessed with trying to find winners. It's not really true. It's the fund which needs to have a winner. What investors are obsessed with doing is looking at the deal flow that comes over their desk, over the transom, and squeezing out the lemons. Saying, I want to go and assassinate those lemon opportunities as quickly as I can, as efficiently as I can. They say, the cherries will take care of themselves. When something comes along, you say, I don't know whether this is going to work or not, but it's clearly worth the risk. Let's put money into it and push it and let it go, and que sera, sera. Cherries will mature out of those. But they say, I'm looking at this, and I think this is just going to be a trap. Right? I'm going to lose $100,000. Let me see if I can not fund that and improve my overall investment efficiency. You might think of this kind of due diligence procedure as doing like a background check on a potential employee. I cannot think of any situation where there's an employee who has actually been hired because of what came out in their background check. Unless you're trying to hire somebody in order to rob a bank or something. You say, I would not hire you unless you have a previous conviction for bank robbery. Most of the time, the information that comes out in a background check is only bad news. It can only cause something to fall through that you previously were going to invest in. But the reason why employers do this in the first place is because bad news at the beginning is really good news. They say, great, I'm not going to hire you because of what I found. I paid $29.95 for that background check, and I'm going to avoid maybe $100,000 worth of liability. Due diligence for angel investors is the same way. They say, I'm going to go and try to figure out a reason why I should not invest in this lemon and potentially save $100K. I recently gave a talk about how to conduct this kind of due diligence. If you're going to spend somewhere between a few hundred and a few $1,000s checking out an investment opportunity, what would you want to check? And I realized that the return on this due diligence investment is really, really large. Because you can easily, for the cost of $1,000 or $2,000, talk yourself out of a $100,000 loss, right? That's an amazing kind of return. I wish I could just make that kind of investment for a living and not have to worry about the companies actually succeeding. Okay? So every investor ever, is thinking that they want to find cherries, and every business plan ever is written in a way that's saying, look, I'm cherry flavored. I'm the one who's going to win. I'm a perfect investment for you. I'm going to return 10 times on your money. I'm going to return 25%, dot, dot, dot. Every single business plan always writes themselves this way, saying, I want to look like a cherry. However, every business plan reader is like, yeah, sure, you're a cherry. Just like It's like these lemons are dressing up in Halloween costumes, with little stems, and they're painting themselves maraschino colored. But, at the end of the day, they're a lemon. And so every lemon business plan ever is saying, how can I find an unsophisticated investor who's not going to actually do their homework, who's not going to go and check me out, who's not going to go and kick the tires and ask me tough questions, and maybe they'll give me money even though they really shouldn't. There are opportunistic entrepreneurs out there who would not invest in their own ventures, but they're happy to invest other people's money, and they really, really, really want to have their startup, and if they don't have their startup, they have to go and work at Sears or something, and they'd be willing to do anything in order to actually have a real job. And so they will go out and pitch incredibly crazy speculative ideas to other people without putting any capital in themselves. That will only work if your investor is not able to actually do this due diligence. They're not able to actually push you on these things. And the key to getting funded, and this is the only thing I'm going to say about getting funded when you're a lemon, is you basically have to say nothing. Because anything that you say can and will be used against you. And when you provide true information to these investors, they figure out that they shouldn't invest in you, and you have to go and work behind a retail counter somewhere. And if you provide false information to these investors, then you're setting yourself up for extreme difficulties in the future, not only on the financial side, but also on the criminal side, to say nothing of the business ethics involved in this. But this basic idea of saying, I'm simply going to show you something, I'm going to go and present to you what I want you to hear and not tell you the whole truth, basically is creatively keeping your mouth shut about information that these investors should know, and it leads to something called pooling. And so pooling is pretending that you're just as good as all the other business plans, and declining to provide the information that the investor actually needs in order to determine what you really are. Okay? So the opposite of pooling is separation. And so every good business idea is constantly saying, gee, it's really hard to raise money in this environment. The reason why it's hard to raise money is because of all these darn lemons. There are so many bad business plans out there that investors are gun shy. They don't want to put money into things which are not practically guaranteed of success. And they say, I don't know, I've been burned on a lot of lemons before. Every good business plan wishes that these bad business plans would just give up and go home. So the trouble is, of course, these bad business plans are out there in the market. They're trying to raise money. You're competing with them. And you say, how can I persuade my investor that I am not a lemon? That's what separation is. You cannot do this by keeping your mouth shut, because the lemons are keeping their mouth shut too. And they're relying on you not being able to talk with your investor so that they can stay in the pool and potentially get funded. So what you have to do, if you want to go and separate from the lemons, is to open up your mouth and say something intelligent. You must provide your investors with extra information that lemons cannot possibly afford to tell them. Right? This is going to be the trick. So now we're going to transition. Now that you've thought like your investor for a little bit, we're going to transition to saying, what can you do as an entrepreneur in order to have a better experience working with your investor? Okay? So the first way is to be very specific on your use of funds. A standard business plan, and this makes me cringe every time that I see it, a standard business plan concludes with a slide that says, hey, we got a deal for you. You give us $400,000 and you can have 10% of our business. It basically is an offer. And it's an offer as if you, the entrepreneur, are in the driver's seat and you're the one who are making all of the offers and making the plans. And you're like going out and trying to conduct some kind of partnership offering and raise money for a real estate venture. Right? That's a very standard way. I think it's the wrong way to do it for small amounts of money for high-risk ventures. And the reason is, anybody can do that. You can put together a very slick deck, as we can see from business accelerators. You can learn to put together an amazingly slick and professional-looking deck in a few weeks or a few months, which doesn't necessarily have a lot of business substance behind it. There are a lot of lemons doing this. You have to do more than that. However, the right way to do that is to take advantage of what you know. You know your business very well. Your business needs capital to grow. You, as the founder, know exactly what you're going to use this money for, and you need to convey to your investors that you're going to invest in the business and make it grow, and not simply take half the money and put it in your pocket, because you are going to go and invest the money in the business and make it grow rather than putting the money in your pocket. If you put the money in your pocket, you're a lemon. Okay? So the whole idea is this is you as a good idea. So, I know this is going to be a revelation, but perhaps, given that you have a lot of expertise about your business and you've worked out exactly what you're going to spend the money on, and you're going to invest it in growth rather than basically filching it from the cash register, maybe say that in your pitch. You should say, here's what the money is going to be spent on. Here's exactly what the money is going to be spent on, when it's going to be spent, and what will be achieved by spending it. And so I joke about this. I say you should treat your investors like your personal ATM. And here ATM is a mnemonic device standing for the amount, the time frame, and the milestone that it's attached to. So you want to end with a statement that says, as you see from this table, this breakdown of where the money is going, we need $250,000 to get us to this milestone, right, bring us to market, which is going to be spent on design and prototyping. So what is it going to be spent on, and when, over the next 12 months. And then the investor says, oh, I get it, you need $250,000. You've given them the same ask. You can make it $400K if you want, whatever number you're asking for. You've given them the ask, but you've explained what you need in order to succeed, and you're entreating them to become your capital partner in this venture, and then say, oh, I get it, we're supposed to come back with some kind of an offer which will get the company $250,000, and they know exactly what it's going to be spent on. And if they go in and they say, we expect you to actually spend it on what you claim, you say, that's great. There's a reason why I put that table up there. It's what I plan to spend it on because I am not a lemon, right? I'm a cherry, I'm going to spend money on this. And if they then say, well, we have $250,000 for you, but you said you're going to spend $40,000 on rent, can we pay your landlord directly? You want to say, great, right? Perfect, right? No problem, that's exactly what I would have done with the money. Your goal with this investor meeting, at the end, you want to have investors saying, I love you, and then you can say, I know. You want to have investors saying, this is the entrepreneur that I want to be working with. I want to get my money into this venture. I want to get my money into this venture early. And if your investors are thinking this way when you leave the meeting with them, you don't have to say, I'll give you 10% of my company for this amount of money. You show them how much money you need, they'll come back with a term sheet. They say, we've decided we want to work with you. We have $250,000. Here's what we propose that we do. Right? That's your goal. You have done everything that you can as an entrepreneur. As I said, I just cringe, and I see a lot of business plans that have this as their final slide, when the entrepreneur proposes how much of their company they're planning to give up for this amount of money. That's a terrible way to actually work with an investor. If the investor comes back and says, sure, we can invest $250,000, but you have to give us 75% of your company, you can always say no. You can say, no, I think I can find a better deal somewhere else. But you want every investor to come back and say, I want to work with you. You obviously belong in my portfolio. Let's see if we can actually make a deal. Right? That's as much as you can do. Okay? Let's go on to the next slide. So how can you actually talk the investor into funding you? In addition to putting out how awesome your business is and how big the potential is and all the standard things that show up in a business plan, what else can you say that will make the investor want to actually work with you and say, this is more likely to be a cherry than a lemon? So number one, you can show them how much of their capital is actually at risk and how much of it isn't. If you're talking about creating something from scratch, you have this basic prototype and you have to go and turn it into a product, and then you have to go and buy Super Bowl ads, and the money is going to be spent on advertising and it's all going to burn up in one day, you say 100% of it is at risk. If, on the other hand, you're talking about buying a rental, you're talking about creating a rental business, and you're going to buy a lot of lawnmowers and portable air conditioners, and then at the end of the summer, you're still going to have a lot of lawnmowers and portable air conditioners, not all of that money is at risk. It's very important to say how much of it is likely to go away if this business fails and how much can actually be salvaged. If there's something which is not at risk, it is possible to use some form of money other than venture capital to actually fund that business. Now, if you can get a bank with the support of your investor to loan you money in order to go and buy those lawnmowers and portable air conditioners, that's great. Your investor will support that. If you can't, however, the investor would rather put that money in rather than having your business fail. They just don't have to have the same kind of return expectations for that money, because after all, it's not at risk for being a lemon the same way that the other equity is. And so if you go and show your investor that even if the business folds after a couple of years, they can get 50% of their money back, it makes it a lot more attractive for them to actually put money in the first place. A lot of entrepreneurs don't bother with this. Some business plan books actually tell you not to do this. They say, tell your investor that all of the money is at risk because who knows, if you lose the money, they might sue you or something. But they say, don't tell people that you're thinking about failure because only losers think about failure. I couldn't disagree with this more. tell your investor and show your investor what you know about this business and what's going to happen. Show them that you have thought about how this works. Show them what it would take in order to cause you to cash out of this business after a year or two with a 50% loss. Meet that problem head on. It will impress your investor and make them a lot more likely to actually fund you. You can only benefit from this if you can find some naive and irresponsible investor who's going to invest somebody else's money, throw money at you even though you have no plan, and then you can put half of it in your pocket and lose all their money and everything is good. It's really hard for you to come out ahead by having your business fail, right? But by being very clear about what happens when your business does fail, you show them that your interests are aligned with theirs and that you're going to do your darndest to make the business succeed. Okay? So along with that goes along with the risk-reward trade-off. You say, for the number of dollars which are potentially at risk, for the amount that you're potentially going to lose if the business turns out not to work out, you're getting a much higher return if we succeed. And you say, sure, you're getting a 10 times return on the total amount of money that you're putting in, but you're getting a 40 times return on the amount which is actually conspicuously at risk. The other 75% is going sideways. You're going to get that back no matter what. So we're kind of like a quarter like a cherry and 75% like a sideways investor. That ratio is what they're after. An investor who is able to put lots of little investments in, all of which return 40 times on their money, is going to be just as rich as somebody who makes one big investment which returns 40% on their money. What they want to be sure of is that for every dollar that's potentially at risk of loss, they get a decent return. Okay? That's the important part. And so the relevant measure is the return on the at-risk capital, not the return on investment on the total capital which is invested in the venture. Again, if you could find an external provider of debt to actually put the money in, there are banks which thrive on this kind of thing. If your equity capital provider is putting in $100,000, you can often find a bank to loan you $50,000 or $100,000 or $200,000 as well. Right? Those two go hand in hand. Your equity provider will be more than happy not to have to put up the money. But if their choices are putting up the money versus not having the venture go, they'll figure out a way to actually make that investment work. Explain to your investor how getting in early gives them extra potential for getting in later. Right? So for example, it's very often the case that when you have a lead investor who comes in who's going to put in the first money into your venture, you give them better terms or you give them the opportunity to invest more later at the same terms. The idea is they put in $25,000 or $50,000 now, and then you give them a warrant. You say, I'm also going to let you put in $25,000 or $50,000 more next year under the same terms. If it turns out that we work together for a year, you think we're good managers, and we haven't necessarily hit the jackpot yet, but you're pretty confident that this is going to work out, and you're happy with having 100K in rather than 50K in. That can be a very, very powerful incentive for the investor to put money in. It doesn't cost you all that much because you're getting money now when you really need it. If it turns out your business fails, that money does not get invested because they're not going to go and invest the extra money in a failed business. Next year, it's going to turn out that you have given them the deal of the century because you've allowed them to invest at the initial valuation twice as much money, having gotten a chance to see you in operation the first year. So this is important because lemons can't make that promise. Bad businesses do not come out ahead by doing that kind of promise. And the reason is, after working with them for a year, you say, I'm sorry I put in the first $50,000. I'm certainly never going to put in the second $50,000, right? And so this is a way to separate yourself and to distinguish yourself from the bad business plans that are out there. You want to set some milestones where you say, look, if this business isn't really operating very well, if it doesn't meet these milestones, we're going to shut it down, sell off the lawnmowers or whatever we can salvage, and go on to the next business idea. So there's a famous article from the Harvard Business Review called Discovery-Driven Planning. It's by Rita Gunter-McGrath and Ian McMillan. It's one of the all-time best-selling entrepreneurial articles ever. You can get it for free in a number of areas. Just Google on Discovery-Driven Planning. You can easily download it. And it basically provides a step-by-step method of figuring out what has to go right for your business to succeed. And so it's like thinking about doing a business plan for a business you haven't started yet. What do you need to assume is going to work to make this business plan actually reach your objectives? And then you look at these and you say, gee, I'd have to sell 200 tomatoes to every restaurant in Dallas. I don't think that's going to work out. It allows you to put business plans away before you invest money in them. But the whole point of discovery-driven planning is that you set milestones where you say, if we have not achieved this level of success, want to show your investor that you, the entrepreneur, not only have faith in your idea, but your time is valuable. And if this isn't working out, you're not going to go and try to hang on for another 4 years to try to draw a meager salary out of this venture. Instead, you want to get out of this, shake hands with your investor, take a modest loss, and go on to the next idea. Lemons cannot say this, okay? Lemons do not want to let investors out. Lemons don't want to give up their jobs at this bad idea. You, however, say, as an entrepreneur, I'm eager to go on to the next thing. If you do the math, for small investments, your opportunity cost of time of working at a failed or failing business is much higher than your investor's opportunity cost of capital, right? If they're investing $100,000, in that venture, maybe it costs them, $6,000 or $10,000 or $25,000 a year to have that money tied up. It costs you a lot more than $6,000 or $10,000 or $25,000 to go in and punch the clock at that business rather than starting up something else. Right? So you want to show your investor that your incentives are aligned with them. And finally, just kind of a little throw-in section, I teach a whole class on competitive analysis for startups in my entrepreneurial strategy course. Show your investor that you have thought about what's going to happen in the marketplace, who else is going to go and try to put you out of business, and how you're going to deal with them. I moderate a lot of investment panels for business plan competitions, and I always poll the judges about what they wished these presenters had spent more time on, and they all say, I wish they had spent more time on competition. They also say, I wish they had told me more about how they're going to use the money, but I've already said that. They say, I wish they had done more competitive analysis and explained what could possibly go wrong, who's going to try to get in their way, and what they have planned out in order to do that. Okay? So that's talking the investor into funding you at all. Now, given that we've talked them into funding you, now we get down to the part which is actually distributive rather than integrative. Previously, we've been talking about working with them as a partner to create win-win solutions. But now, you actually have to get down to brass tacks here. You have to negotiate how much of your business, what kind of equity or what kind of participation they're going to get in exchange for their capital investment. So as I said, you want to get a good pre. That pre stands for the pre-money valuation. That is the amount of value that your investor is giving you credit for having already created before their money goes in. And so the idea is they say, hey, I think that your idea or your prototype or whatever it is worth $500,000. How about I put in $500,000 and I'll have half of the company that follows, right? They're giving you credit for having created 500K, they're putting in 500K, the pre-money valuation is 500,000, the post-money valuation is $1 million. I wouldn't advise giving up 50% of your company for 500K, that's just a mathematical example, okay? But you need to talk your investor into a pre-money valuation, not only which will generate enough cash for you to achieve your business goals, right? We already explained what you're going to use the money for, but which will make you happy that you actually worked with that investor. And so you want to emphasize the risk-reward trade-off we talked about before. You say, you're not putting in that much money, but it could turn into something which is 50x your capital. And that allows you to talk them up in the pre-money valuation. You say, this thing is now valued at $1 million. We think it can turn into $10 million. Going from $1 million to $10 million gives you a 10 times return on your capital, but only $250,000 of the original $1 million is at risk. That's a 40 times return on the capital which is there. That allows you to turn your business plan or your very small business into something which your investor will treat as if it's worth $300,000, $500,000, $1 million, $2 million, whatever. Your pre-money evaluation as an entrepreneur is where you make money in these negotiations. Because since your investor is giving you credit for this, it's not quite the same as selling your business to the investor, but you are equivalently getting the investor's cash for less of your company by having a better pre-money valuation. You can offer them sweeter options later on. You say, well, rather than putting in money at a $1 million pre-money valuation, how about you buy stock at a $2 million pre-money valuation, but I'll give you the option to buy more stock at the $2 million pre-money valuation later on. Right? They can agree to that and get the same kind of risk-reward trade-off, and instantly you've doubled the value of your company. Right? All you have to do is just offer this, and some investors will say yes. This will especially matter if your business is going to obviously succeed or obviously fail within a year or two, and you're going to be raising money in a later round at a much higher valuation. I've had a couple where I managed to get in at the $500,000 or $1 million pre-money valuation, and their next round was done at $5 million. And so instantly, that initial investor has made 5 to 10 times on their money, and yet the business is still growing. So if they think they can get you to that critical level of $5 million by achieving your milestone with you spending their money using exactly the plan that you have laid out to them, they'll look at that and say, okay, that's good. I'll give you credit for having created $500,000 or $1 million just with your business plan and 6 months worth of due diligence, 6 months worth of work. That's a huge implied wage for you as an entrepreneur. The goal is to think about what you're getting in return for taking an investor on. You can stress to them that you need both at-risk and not at-risk capital, but that you're asking them for the at-risk part. You say, we can go and borrow money somewhere else. We can go to hard money lenders, we can go to banks. There are a number of banks who do venture lending in conjunction with equity capital. And you say, but we're going to have to pay them a lot of interest. So, Texas state law allows you to charge 18% APR on business loans. There are a lot of money lenders out there who charge 18%, sometimes plus a little bit of extra, in order to provide, loans to businesses. And you say, we could do that, but wouldn't you like to actually capture that return instead? If we pay out a lot of money on interest, you're paying for part of that because you own part of the company. Wouldn't you rather actually be the lender? And the investor might say, sure. Or they might say, no, I really need to focus on equity investing, but I'll help you go out and get a better rate at Comerica or Wells Fargo because I have a relationship with them. Either way, you win. You can offer them dilution protection and tag-along options. And so dilution protection simply says, well, you're paying, again, I'll give you an example, you're putting in $100,000 for 10% of the company now, and you say, you will still have 10% of the company even after we go and raise more money later. And that's what dilution protection works like. They say, otherwise, when you raise more money, they'd go from 10% to 7.5% to 5%. You can still make a lot of money owning just a few percent of something which is worth an enormous amount, but that dilution protection is very valuable to your early investors, and it doesn't cost you all that much. Similarly, you can offer them tag-along options, which says, when we raise money later on, I guarantee that you will be able to also put more money in later on at the same terms that the other investors will do. You say, you're getting better terms now, right? Give me money now because we need it right now, but you'll be able to participate later on, whereas a typical investor doesn't know whether they're going to be able to put more money in later. It's up to you as the entrepreneur to decide whose money you're going to take. I personally think that you should explain to your investor, or at least signal to your investor, that incentives are important, that you want this business to succeed, that you're willing to put in 100%, if not more, of your effort, and that you are completely committed to the success of this entrepreneurial venture. But, it never hurts to ask for a little bit more incentive. It's entirely possible to motivate people who are coming on in the business, other than you, that is, to do extraordinary things, to put in a huge amount of effort in exchange for a very relatively small percentage of the company in terms of stock options. They come in and they take 1/10% or 1/4% or 0.5%, and they work non-stop for you for a year and a half for only $3,000 or $4,000 a month. You're able to pay them relatively small amounts of cash, but you pay them in options which are valuable on the upside. And you explain to your investors that you're going to be going and building your team and compensating them with options and not with cash. That gives them extra leverage on their original investment. If you show that you know what you're talking about there, investors are willing to give you credit for creating value in the future in your business, and that will then reflect what kind of value you can get from them before they actually put money in. So I mentioned $3,000 or $4,000 a month. So this is something that I say a lot to investors. And I work with my MBA students in order to explain to them how it's possible to actually keep body and soul together on $3,000 to $4,000 a month. Lots of people do. That's like the median household income in the United States. It is really, really hard to be a startup founder and not have any cash coming in. I mean, you have to have saved up an awful lot of money in order to make that possible. It's simply not sustainable for you to live a high-stress founder's life and be whittling down your savings and constantly be worrying about when you're going to go and run out of money. And especially if your spouse is constantly, carping at you about, burning through this money and not getting any response, it's really hard to do that. On the other hand, if you know that you have $3,000 or $4,000 a month coming in from the business, if you've cleared this with your investor and you say, yes, I am going to take a salary, but my goal is not to get rich off of this salary, I'm not trying to drain the money of the company, this $3,000 or $4,000 a month is just to keep me in good shape so that I can put all of my effort into it, the investor will say, oh, that sounds pretty reasonable. I have never seen an investor who says, gee, this is a ploy in order to get a $36,000 a year job. Particularly if you're coming with an advanced degree or some experience or a patent or something like that. No investor is going to think you're trying to pull the wool over their eyes when you pencil yourself in for $3,000 or $4,000 a month. And so I would advise you, don't take a founder's salary of higher than that with your first round of investment. Later on, when you raise multiple millions, then you can deal yourself in for a real executive salary. Nobody will care at that point. But you go and you say, I need this much money in order to kind of keep things together. I've kept it at the minimal level. I'm keeping most of my founder's equity. I don't want to raise extra money just so that I can then pay myself, right? That's not your goal. This is also something that a lemon cannot afford to do. You know, people will not be interested in working on ventures which are not going to succeed just for being able to draw $3,000 a month of salary. Whereas if you start drawing $10,000 a month of salary, there are a lot of people out there who will work in any business, no matter how terrible it is, for $10,000 a month. This is a way to prove that you're serious. And finally, you want to charge a lot more for a controlling interest in the firm than for a minority interest in the firm. You want to be selling off 10, 20, 25% of your business at most for this initial round of funding. You want to make sure that you still have solidly more than 50% of the shares, not only so that you can manage it effectively, but so that you have room in order to sell some more shares later at a much higher valuation. So you may find an investor who comes in and says, yes, I'd like to buy more than half of the firm, and they'll offer you what seems like a lot of money, and you look at that and say, they're paying me $1 million for 51% of the firm. That sounds like, you know, there's a pretty serious pre-money valuation in there, right? $2 million right off the bat. You're tempted to say yes. The trouble is when you do that, you've cut yourself off from a lot of future appreciation. That's the mark of a lemon, right? Lemons want to go and get all the money up front for a large share and sell lots and lots of stock up front. Whereas cherries want to say, no, I just need $122,500. I've worked that out. I think that's going to be enough. I want to sell as little as I possibly can, and I want to raise money at 5 times the valuation in a year or two. I don't want extra money now. All of these things are very important to getting your investor to say yes, because you're holding up a sign saying a lemon could not do it this way. Right? I belong in your portfolio. I am not a lemon. Okay? Let's go on to the next slide. So just a few thoughts about doing a second round. And so, you know, as you might have figured out, I not only teach this stuff, but I also do it. I've invested in dozens of startups in amounts ranging from $10,000 up to $100,000. I don't think I've put $100,000 of capital into more than 100K into any given startup yet, but there will always be this opportunity. And believe me, I've had plenty of lemons. Right? I cannot pick winners 50% of the time. However, I'm doing better than 1 in 8. Right? So, you know, I guess we have to be grateful for those kinds of things. Very frequently what happens is that no plan survives initial contact with the enemy. The business plan that the investor put together, and they found out that they needed $150,000, and I went and put in $50,000, and 2 other people put in $50,000. They find out 6 months into it that they need another $50,000 that they didn't plan for. That kind of thing happens. You don't assume that they're a bad manager just because they weren't able to predict the future. It was actually the physicist Niels Bohr who said predictions of any kind are hard, but especially those about the future. It sounds like it's Yogi Berra, but it's not actually. And so there's no problem if they need this. However, it's extremely difficult to go to a stranger, to a brand new investor, and say, I need $50,000 right away, or either my business is going to fail, or I'm going to miss out on this amazing opportunity, which is going to cause my business to grow. The typical investor at that point says, lemon alert. Right? This person needs 50K, they need me to make the investment really quickly, without a lot of extra due diligence. They're showing me a business plan which is 6 months old. They're not able to tell me a lot about what happens. This has conveniently come up in a time when I have to make my decision very quickly. And so it's very difficult to actually get a new investor to put money in there. However, an existing investor who has already gone through your stuff, who's vetted you, who's vetted your business, who knows that you're real, who's watched what you've been doing for 6 months, who you've been keeping up on what's going on, who's seen this opportunity develop or seen the difficulty develop, will say, okay, I could see my way towards putting in some more money at this point, but it's going to cost you, right? You're going to have to give substantially better terms because you need this money quickly. It's either because your business is kind of potentially floundering, or it's because there's this great opportunity out there, which if you don't have the money, you won't be able to seize. So, you know, as an investor, I love these kinds for, and rather than specifying what it is that they'll take, they say, can we come up with a creative way so that we can grab this opportunity together? And very often there's a way to be able to say yes. A lot of entrepreneurs miss this opportunity because they either try to raise too much up front, or they say, well, I could never give an investor a good deal now because that would betray my existing investors. I don't want to do a down round. I don't want to raise $50,000 saying my business is only worth $1 million. I mean, I'd have to give up 5% of my company. And they miss out on the idea that they could make their business worth several $1 million if they manage to make it happen. And the opportunity just passes them by. So what's the solution? When you need money urgently, number one, be very happy that 6 months or a year before, you have persuaded your investors that you are the entrepreneur that they want to work with, that your business is the one that they want to invest in, and that they wanted to get in their initial capital beforehand. So have existing investors who have already done their due diligence on you and on the opportunity. Come to your investors and say, guess what? We didn't think we were going to need money, but we do. Here is what we need the money for, right? How much money we need, $50,000, the amount. Here's the timeline, right? We need it quickly, and we're going to go and spend it almost immediately over the next 3 months. And the milestone, you say, here's why we actually need to have it and what's going to happen if we get this money. Same method you used before, saying you have this one-time need right now for this specific amount of capital, and you say, I'm open to a creative offer, right? Can you see some method by which you could put more capital in? And you point out to them, not only will they be able to profit by providing you capital when you need it, but their existing shares will be worth more because of that, because your business is going to be worth more, because you actually have an idea of what you're going to go and put the money in. So after you put this idea to them, and while they're trying to think about some kind of creative idea, you can do a little bit of calculation on your own. You ask yourself, how would I solve this problem in a perfect dream world? Right? How would I say, well, I'd love for an investor to just show up and say, oh, you've made a lot of progress in the last 6 months. I'm willing to give you twice the valuation that you got in your previous round. And you say, well, previously I did the valuation at $2 million. I'd love to be able to sell stock at $4 million. Wouldn't that be great? That's a bad number. I'd love to be able to sell stock at $5 million. Wouldn't that be great? I'd only have to go up 1%, right? You need 50K, 1% of $5 million. And you say, okay, that's the dream world. And then the little dream bubble pops on top of your head. And you say, okay, in my dream world, I'd be giving up 1% of my company, right, to get this money. And then the investor comes back to you and says, well, okay, I'll put some money in, but instead of you giving up 1% of your company, you're going to have to give up 2.5% of your company. Right? You say, this is not my dream world. They come back and they say, or, you know, I want to get my $50,000 repaid with interest in 3 months, and I want to have a warrant for 0.5% of your company that I can buy at any time over the next 5 years. You can then calculate out what the difference is between what your investor is proposing and what you would have had happen in your dream world. And then you look at that and you say, well, okay, you know, I come out $10,000 worse this way. You convert this to a dollar amount. Rather than focusing on your valuation or focusing on dilution or anything like that, you say, it's going to cost me $10,000 personally as an investor to seize this opportunity. And then you look at that and say, boy, that's great, right? For a cost of only $10,000, I'll be able to actually either avoid this huge problem, or I'll be able to go off in a different direction, which is tremendously promising, at which point you say, great, it's a done deal. Once you reduce it to that amount, you can spend endless days arguing about what the valuation is going to be or what the terms are going to be, but once you, as the entrepreneur, reduce this thing to the cost of getting out of the jam, or the cost of exploiting this one-time opportunity, you've basically solved the problem. Your investor will come back with something where you say, okay, that's palatable. Maybe you'll only get 70% of the benefit, and you're going to let your investor get 30% of it. It's okay. That benefit is not going to happen at all if your investor and you don't actually get together in order to make that happen. And so as I said, right, these are just kind of my final thoughts about raising much-needed money without giving away the store. Previously, you were thinking this through, you had a long period of time, you had all the time you needed to plan, you could think about exactly what it is that you needed to get, you can describe to your investors exactly what you need to spend it on, and you can prepare a presentation which shows that you've thought about them as an investor. It shows that you have this theory of mind going on inside your own head, and that you've thought about what they need. I promise they will be receptive to this. I promise that they will not think worse of you because you are thinking like them and trying to make this attractive to them. I've given you some tips about how to actually negotiate these deals at the negotiating table, what kind of things you can throw in to make it more attractive to them, to get them to say yes and to bring you an offer. And then finally, I hope that I've given you my perspective on how to deal with things that you have to get done in a hurry. This is not going to work with people who have not worked with you before, because you really don't have enough time to show them that you're high quality and they want to make this investment. But your existing investors will not only look at you and say, this is great, but they will respect you more for thinking about them and bringing them the opportunity in order to make their existing investments more profitable, while also showing them the opportunity to work with you in a creative fashion. And so with that, I think we have some time for some Q&A, and I'd love to hear your questions or suggestions of what you've heard of that works, or I'd be happy to answer questions about how you would go about doing any of this in practice in a business that you happen to be operating.
So you didn't bring it up, but it's definitely okay. And I want to be able to ask, outside of going to business pitches and things like that, how else would you go about finding an investor?
Well, so
we explain the question so we can record that. Yeah.
Right. So the question is, right? How do you go about finding an investor? So you suggested that you could, go to, and this is going to be most of my answer, but the basic answer is go to places where investors are and meet them, or talk to people who know investors and get introduced.
Gotcha.
And so, investors go and have breakfast and lunch with a lot of people and coffee, right? I have $500 on my Starbucks gift card, and I meet people for coffee all the time. The great thing about meeting entrepreneurs for coffee is that for $1.70, I get to meet them whenever I want. And so I say, hey, how about we meet at the Starbucks at Preston Center for $1.70? I can get you to show up to that meeting. I'll buy you a cup of coffee. We can talk for half an hour, right? It's a very effective way. Just about any investor is interested in, doing some initial discussion with you, provided they have some reason to believe that you have some promise. And so if somebody introduces you or recommends you, or if you meet them at an event which is designed to bring together promising entrepreneurs and promising investors, they're willing to do this very initial kind of casual meeting. Don't be upset if most of them say, after having one cup of coffee with you, I don't want to have a second one, because most of the time they have to just eliminate people from their consideration. And as I said before, they have to eliminate 6 or 7 or 8 for every one that they're going to fund.
Perfect.
There are plenty of investors out there, but basically, right, meet them or get introduced to them, ask them for a meeting, and say, I'd love to be able to just show you a few things about what's going on with the business. Do not let them get out of there without the ATM, without saying, I need $50,000, I'm going to spend it over 6 months, I'm going to spend it on this. Even if they don't actually fund you personally, they may refer you to somebody who is interested in that, and you may find that something completely random happens a few weeks after that, just because you took the meeting with that investor.
Perfect. Thank you.
I'm really interested in forecasting.
Okay.
And I feel like a lot of founders, they just throw out 12, 24, 36-month forecasts. They really don't know how they're going to get there. So what principles would you maybe offer to an entrepreneur that that is looking to put together something that's realistic? Because they're all like, oh, my forecasts are ultra conservative, right? But there's probably a limit, as you say. So what would you recommend there?
Well, I would say, be prepared to answer questions about how those forecasts were created. If you basically say, well, so I picked a number and then I increased it to 8% a quarter for every quarter, I just sort of copied right with Excel and I got some really big number, you found a lemon at that point. So I would say all good forecasts are bottom-up forecasts. If you can't tell me how you're going to get your first half dozen customers, you can't tell me how you're going to get your first 100 customers. And so spend a lot of time in the first couple of quarters saying, okay, here's how we get customers, right? I have this list, I'm going to call them, I have people who are going to go and talk to them, we're going to go and convert 12% of them, I've talked to a dozen of them already and 2 or 3 of them are interested. Build that forecast from the ground up and it will be credible. It can't be accurate before it actually has a plan underneath it. And I think your investor will be willing to believe you if you say, hey, we can scale this up pretty painlessly at that level. I mean, that's not very original. It's discussed in the Discovery-Driven Planning procedure, but it basically says, figure out how you're actually going to accomplish it. And then at that point, you can wave your hand a little bit and say, so I've worked out what's going to happen in the first 4 months and exactly who we're going to talk to and who's going to be doing it. Now let me see. That says we're going to go and grow it 22% a quarter. If we extend that out for an additional 8 quarters, and then you're explicitly telling them you have moved away from something which is bottom up, and now you're thinking about just kind of extrapolating it. You say, if we extend that for the next 8 quarters, here's where we end up. You've been just kind of an indicative number to say, if this works, this would be what you were looking at. And you're just inviting your investor to say, okay, I'll take a look at that, but they're going to come back and press you on the specifics later on. Please, go ahead.
Were a lot of your early statistics based on angel investing or venture capital, which are starting to now mix?
Mm-hmm.
But, I mean, there's like the Halo report and some things like that have these statistics that prove this out pretty well.
Mm-hmm. Well, I mean, I think it varies a lot depending on, you know, what type of industry is being invested in, how many deals are being presented, right? You know, there's a complex process of saying, not only are you, these are statistics for ones that you actually invest in, right? So not only are you investing in a subset of the ones that you looked at, but you've considered investing in many hundreds of other ones. And so, you know, the 721 number is just set up in order to create a nice mathematical example in order to say, here's what happens when most of your original investments fail, but you can still come out ahead. Clearly, that statistic varies a lot depending on how much filtering you're doing up front, depending on what the base rate of success is in businesses, and you know, it is quite different for manufacturing versus services for transportation businesses, for example, than it is for high-tech innovation. So, you know, don't place too much emphasis on the 70% failing number. What I wanted to do with that example is to say, for every one that succeeds, here's how many failures it can bring along with it, right? Think of it as the offensive lineman dragging the football down the field and 2 or 3 defenders behind him. You say, how many failures can be put up with given this kind of risk-reward trade-off? But as you mentioned, right, you know, you can take a look at the actual returns of some, you know, pretty well-documented funds and angel groups.
We've got a lot of good statistics.
Right, in order to get an idea of how that works. But the trouble is, I don't think you can necessarily learn a lot from that, because you don't know how many other investments they passed up, right? And you don't know how investments that they passed up did. And so when you try to look at their performance and how many succeeded, you don't know what the correct counterfactual is to evaluate that against. You can't, for example, compare it to an index of all of the startups that they looked at, right? The same way that you could compare a hedge fund's performance against the S&P 500, because you literally don't know what the alternative was going to be. And so you can get that data, but it's kind of dicey to try to make any significant inferences from it and to be able to replicate their performance because you don't really know what else they didn't do.
Now, the other flip side to this a little bit, from an investor's mindset, you wonder sometimes if they invest in 8 deals, they have 1 cherry and 7 lemons.
Yep.
They don't tell anybody about the 7 lemons. All they ever really publicize is the cherry, and some of that is about their ego, that they brag. You know, and so all the cherry gets the publicity and the 7 lemons get 0, and so they kind of just wither away. Okay. So I sometimes wonder, you know, some of the investor mindset of trying to hit the big thing is because they want to be a part of the big thing. Because I own 1% of Facebook or whatever.
Well, and I think this leads to a lot of, I would say, inefficient behavior by investors. They want to make sure that they are not shut out of the next big thing. They want to make sure that they have some Uber in their portfolio, for example.
Fear of missing out.
And exactly, right? And they're willing to pay outrageous valuations for tiny little slivers of these companies, like window dressing, just to show that they have something like that in their portfolio. I mean, I don't quite understand that, but I can understand how there could be both psychological reasons, as you described, and objectively financial reasons. If there are potential limited partners who are going to be investing in their future funds, who are going to notice that they invested in Uber and not spend a lot of time doing due diligence about figuring out how early or late to the party they were and how much they spent for their sliver of Uber, that might actually work. And so I would say, you know, you ask yourself who benefits from this kind of thing. I suspect that the reason why investors are doing this is not because they believe that they're going to make a huge profit by investing in Uber at a $50 or $60 billion valuation, but they want to be seen as being a different kind of investor because they're willing to do this. And I mean, that's a game which is a couple of orders of magnitude above what I'm talking about here. I'm talking about people who are actually trying to get in early, you know, at a $1 or $2 million valuation at most, and try to turn these companies into $5 or $10 million valuations and flip them, right? Get bought out, right? Get converted, get cleaned up in later rounds, so you can turn around and recycle your money
opportunity, maybe the technology applied to the market opportunity, in regards to the pivot. You know, what happens when it's either kill it, it's not meeting its metrics, or we need to do something different because we've climbed the top of this mountain, which we have a new view over the horizon. How does that turn out in the real world of investing that you've seen?
Well, I think there are a lot of investors who are just not willing to put time and energy into companies that are not doing well, right? That are not meeting their objectives, that are not outperforming. So this is the so-called kill the runt strategy. And especially in very kill the runt strategy, right? My understanding is this, comes from the practice of pig farming, where you have a litter of, 4 pigs that are going to grow to maturity, and you have one that's the runt. And you say it's not worth actually feeding the runt because it's never going to produce enough bacon to make it worthwhile. And so you have to say, well, 5 were born, but really there are only 4 viable ones, right? You have to kind of, cut it off as quickly as possible. I think there are a lot of investors who have enough deals going forward and have enough companies that they're dealing with that they say, I just can't put any time or money in trying to salvage my $100,000, right? Trying to convert the lemon into something that's just going to go sideways. And they just shrug and say, I'd rather just cut my losses, get out, get back whatever I can, sell off my my ownership in this to somebody who specializes in distressed companies, maybe get $30,000 back, and then go on to raise another fund and search for another chair. On the other hand, there are plenty of investors, and for that matter, consultants and right, business services that specialize in that kind of thing, where they say, I'd like to be able to come in and for a very small amount of money, get a noticeable ownership proposition in a turnaround situation. I don't think that just because a startup won't necessarily produce 25.9% compounded for 10 years, that they can't be successful as a business. They're just not going to have that kind of explosive growth trajectory that the investors are looking for. And so, often you spoke about pivot.
Yeah, it's a very popular word right now.
Yeah, people talk about pivoting to say they're trying to get out of a mistaken strategy and into something which is going to work. I would also say there's a pivot to be able to say, all right, we're going to go into damage control mode. We're going to go and try to figure out how to turn this into a business which is going to produce some kind of return on capital, even if it doesn't produce this kind of, outrageous inflation of the capital value in a short period of time. There are all kinds of pivots that are available. I think the trick is when you're talking to an investor, you need to find out whether they are tolerant of the idea that it's possible that there's some middle ground between losing their 100K and making $1 million or $2 million or $4 million. Some investors will say, I'm completely uninterested in struggling with businesses like that, and that's fine. Some investors will say, yes, I'm a little bit more risk averse. I want to go and preserve that capital. I've had businesses like this that turn 100,000 into 200,000. We don't look at those as being cherries, but it's still a lot better than losing your entire capital base, right? Some investors are willing to actually pitch in more. I can understand both sides of that argument. It really depends on their opportunity cost of attention and how many other deals they have clamoring at their table. If they have many, many more investment opportunities, they're just going to want to kill the runts and get out and not spend any time doing the turnarounds. On the other hand, I can imagine that it might be possible to put together a little miniature private equity fund which goes and buys up stakes at big discounts in businesses which are not actually failing. They're just not producing the kind of returns that these venture investors want. And that could build up to a substantial value creation opportunity over time. Okay.
Other questions,
Yeah.
but
Well,
just as we wrap up, but maybe 2 more questions, but as we wrap up, what I'd like to do is ask if there's some takeaways that are aha moments for you tonight that you'd like to share back for what we got tonight. Go ahead with the question.
My question is regarding valuation.
Okay.
False evaluation of the company. Can you talk about some of the how that can be kind of detrimental as far as the company moving forward and for potential investors? If say you have an investor and your company is value add because you just had 10,000, companies looked at $1 million or $100,000, and how that looks for an investor coming in just based on the business plan and the activity of the company.
Okay. Well, so I think I can kind of dodge your question in the way that I'm encouraging you to dodge that valuation problem in talking to your investors. It's my fervent belief that it's investors who set valuations, not entrepreneurs. And so the whole idea is you say, look, I've got this great idea, right? We have a team which is capable of doing it, right? Joe, asked about the team versus the market opportunity. There's this nice, another HBO article by William Salmon called How to Write a Great Business Plan. And he describes how a typical investor, a typical VC investor reads a business plan. They read the executive summary, which is a page or less, to try to find out what the business is about. They skip through about 40 pages of the actual business plan, and they go right to the bios of the team members. And if they don't see something where they say, obviously this is the right team for this, they throw the whole thing in the trash. And they say, you know, if you haven't passed that, right, they literally go right from the executive summary to the bios. You must pass that screen before they're actually going to go and take a look at your financials and think about what the opportunity is. That seems like it's a little black and white to me, but I don't think it's a bad model of the average way that somebody who is inundated with business plans, you know, is forced to go and deal with that. But, you know, I would say it's the investor who sets the valuation. You want to go in and say, I have a solid team. You ought to believe that we can do this. You ought to believe that we know what we're talking about. When we say we need $200,000, that means we need $200,000. And at that point, the investor comes back and says, okay, I feel like I can give you $200,000 under these terms. They're making an offer to you rather than you trying to set an offer and worrying about scaring them off. So hopefully you haven't put all of your eggs in one basket. You've talked to multiple potential investors because you've gone to a lot of ideas, or you've gone to a lot of places. You have 4 or 5 investors who all say, I'd like to get some of my money into this idea early, and then you can work together with several of them in order to come out with a nice blended valuation that will give you the money that you need at a valuation that you can deal with. I think it's that, you know, entrepreneurs who come in and try to set valuations for their own companies are only putting themselves in jeopardy. And at the end of the day, you know, your company, especially a company in a very early stage with a business plan and a few months worth of sweat equity into it, is worth what investors are willing to give you credit for, as opposed to having any true intrinsic value as a long-term cash-generating business anyhow. On the other hand, I can think of very few ways that one can generate $200,000 or $300,000 or $500,000 worth of value in a 6-month period, except by creating a strong business plan and putting together a strong team, and then going out and raising money based on a, you know, $500,000 or $1 million or $2 million pre-money valuation. The amount of return that one can get for one's speculative investment in sweat equity there can be really, really high compared to the amount of time which is put in. But again, you can't base the value of your company based on your own opportunity cost and say, I could have earned this much as an attorney or this much as a manager. You need to let the business idea speak for itself and let the investors figure out how much they're willing to, how much they're going to ask you to give up for the given amount of money that you've shown them that you need. And so that's a long-winded way of saying I want to dodge that question entirely by asking them to set the valuation rather than you. There's a particular form of valuation, a particular form of investment technique which allows them to kick that problem down the road a little bit, and that's the convertible note. A lot of initial investments are made via convertible note, because then that way the investor doesn't actually have to set the valuation. They pass the buck to the next investor. And they say that next investor is going to set the valuation 6 months or a year from now. And at that point you say, hey, that's great. I got the $75K that I need in order to go and get started. It allows us to get going with a minimum of transactions cost. The note can be very simple. The investor understands exactly what's going on. And then later on you'll figure out exactly what percentage of the company or how many shares they're going to have after you actually raise more money later on. And if it turns out that you lose their $75,000 and whatever money you've put in before another investor puts in, it really doesn't matter how many shares they have in the company, right? The company's going to be worth nothing. And so, right, it's kind of irrelevant. So it allows you to put off the valuation of the cherries while, you know, still not worrying too much about how you're going to go and manage your business the next year. Another question or a reflection, a takeaway?
What are our takeaways?
The due diligence thing of the purpose of the due diligence is to figure out if you're a lemon, more so than figuring out if you're a cherry. Is a really good way to look at this that I like in my brain.
That's good. And there's actually, I like it too, because there's something you can do about that. There's a limited amount of what you can do to persuade people that you're great and awesome. I mean, your presentation and your experience and your resume will do some of that, but there are all sorts of things that you can do to make it easy for people to check you out and to say, I'm actually for real, I do know what I'm talking about. You know, I encourage you to probe here and ask me these questions, because the average person couldn't answer those questions.
But I met with a lawyer today, and he was telling me in a private placement to really show a lot of risks.
he made a kind of funny comment, Edwin Mayfield, Eddie Mayfield. And they'd gotten their funding. Part of the deal was that they were going to move into this space with one of their lead investors who's also going to help distribute their technology. And it made sense for them to be together. So here, no more, off to the Nuke location. Great, good for y'all. And we were kind of talking about the win, both the money and the move to a nicer office, et cetera. And he said, it reminds me of my high school football coach. He said, when you score the touchdown, act like you've been here before.
Mm-hmm.
And that's a sort of a piece of it. These guys had an air about them that said, we've been here before, we know what we're doing, we're going to go on with it. So acting like not a lemon, you're a number 5, if you're not a lemon, prove it, don't be a lemon in the first place. That's my big takeaway.
And understand what kind of attitude your investor expects you to bring. You shouldn't be high-fiving your team in the hallway saying, I can't believe they went for it.
Yeah.
Right? They should be saying, right, you should be saying, they asked really good questions. I can see working with these people going forward. Right? We got good advice, right? I respect what they know, etc. That kind of stuff gets back to investors when they know how you're thinking about them. We've seen some disrespect for people who have bought mortgage-backed securities and things like that, right, in the financial crisis. I think that angel investors and particularly professional VCs know that you're going to be back for a second or third round later on, maybe for this venture, maybe for another one. You want this to be the beginning of a beautiful friendship. And so you say, even if they say no, you want them to say, this is not a deal for us, but we thought you really showed that you knew what was going on. The reason why we're passing is this, right? It doesn't meet our return, or it's the wrong industry for us. But then they'll provide you with some benefit and potentially traction or introductions to another investor saying, you should really talk to the guys over at Fund X. They make investments like this. I'd be glad to set up a pitch for you. And at that point, all you've done is gotten more practice for the people who are eventually going to fund you. You will still have to pitch an awful lot before you actually land the investment that you want. But the goal is at the end of the day to come away with investment at a reasonable valuation from people who are actually going to help you succeed rather than just being passive investors.
Does the goal, it just seems the feel that I get from things I read and stuff, that it's more, is it more common that it's really turn $1 into $3 over 5 years? They're both 3x returns. They're both about 25% compounded ROI.
That's about right.
So they're kind of the same thing, but it's not as big sounding. But yet they're the same return.
Yeah.
Is that more? They're a little more quicker than 10 years, is what I'm getting at.
Well, so it's challenging to do that, though. I mean, most venture funds that I'm familiar with want to reserve some kind of capital and do some follow-on investments in the people that they've originally done seeds in. Because if your fund doesn't have the capability of doing those follow-on investments, you're really at the mercy of the people who do. You have the opportunity to get crammed down and you get diluted, and that's just a bad thing. And so I think funds that really have a very short horizon for that need to have very particular targets and know how to actually get liquid within that 3-year period. And I think that's hard. I mean, I think of 3 years as being the normal amount of time that an advisor would spend with a startup, for example, right, in their initial engagement period, or the length of time before you say, okay, is this working, or are we going to go on to another venture? It's hard for me to imagine that even these cherries would be ripe after 3 years.
I mean, it's about 5, but...
Well, okay, or 5 years, right, sorry. Yeah, but, right, and the question is, do you have a pretty well-defined path to be able to get your money out after 5 years? Or are you simply going to go and transfer this asset to another fund at some well-defined transfer price and, right, just, make an accounting transaction that makes it look like there's a 5x return? I mean, or a 3x return over 5 years. I just don't think that, there are some types of businesses which have that kind of ripening cycle, but certainly the typical business that has the potential to return 40 or 100 times the money takes longer than that to actually have some kind of liquidity event, an acquisition or an IPO. And so if you're not able to wait for more than 5 years because of your contractual structure of the fund, you have to do something at the end of 5 years, right? You have to sell it to somebody, or you have to go and bring it to market whether it's ready or not. It's constraining in a way, I think, which destroy value and it crimps the ability of the fund to work with the entrepreneur in order to grow in a natural way. Certainly they wouldn't be averse to getting early exits and to be able to return capital to their limited partners after 5 years. But I don't know of a lot of funds that have that short of a time horizon, even if their objective is to return all of your capital in the first 5 years and then just kind of hold on to things for capital appreciation and gain for the second 5.
Great. Great.
Okay. Well, thank you very much for coming.
It's called
I'm glad that
rapidly
we had
talk to
critical
you.
mass.
Thanks. I hope it works. Let's see.
Part of the reason, Dave, part of the reason I asked that was I'm more into being a microwave.
Let's see.
So I can't, or I can have no exit at all and keep making money.
But you're also the principal. You're not running a fund who's managing other people's money so much as being able to say, I'm going to go, be with it from acquisition through turnaround, expansion.
We'll see. It's good questions.
Deal by deal is what I'm looking at, and not so only I'm only talking to investors.
Thank you. That was interesting.